Hey traders, a very warm welcome to you. So today I want to talk about one of the most popular indicators out there. It's called the MACD or MACD as some people call it. Doesn't matter what you call it, what we're going to look at is how it works, the settings in it, what it's all about, and some strategies that we can develop from it that's going to help us make better trades, or even better, to cut down on some of our losing trades. So let's have a look exactly what it is. We'll run through it, talk about it, discuss it. So MACD is pretty much there on all your charting packages. I've got a naked chart here at the moment, just of Euro US dollar on a daily time frame. Now you can go into your pre-built indicators, whether you're using MT4, MT5, Intertrader platform, Trading View, whatever it may be. It's going to be there because it's one of the most popular things. You just want a standard MACD. So what I'm going to do now is I'm going to just clear off some of these settings and we're going to talk through exactly what we've got. So let's get rid of that. Let's put this on and stick that on. Okay, so the moving average MACD is the moving average convergence divergence. MA moving average, CD convergence divergence. And what it's basically plotting for us is it's plotting us the difference between a fast moving average and a slow moving average. So before we plot this, let's have a look and sort of eyeball what we would get. So a slow moving average has a higher number to it. In other words, it's taking the average of a longer period of time. And obviously the longer period of time you take, the slower the waves of the moving average is going to be. And a fast moving average, or what's defining as fast, is a shorter period of time. In other words, a short time frame. And that's going to be much quicker, so it's going to be tracking price much more aggressively, closer to price, because it's on a short period of time. It's not going to be stretched out over a longer period of time, but it's going to be more noisy. So you kind of, when you're choosing a moving average, you're like, oh, do I want it slow, do I want it fast? This is kind of where the MACD comes into its own, because you're using the difference between the two. It is plotting the difference between the slow moving average and the fast moving average. So in other words, if you can imagine price is accelerating off, the quick moving average is running with it. The slow moving average is of course catching up, but at a much slower rate. The fast is going to be accelerating away. The difference between those two is going to expand, and that's what we're plotting with our MACD. Now it goes one step further. MACD is made up of that plot of that difference between the fast and the slow, but in addition to that you get what's called a signal line, and a signal line is a moving average of that difference. So that's giving us kind of an additional smoothing benefit, and it's showing us a time when we could potentially go long or go short, and generally people will use it when the signal line is crossing the MACD. What we'll do is we'll look at that in more depth about signals in a moment, but let's put it on the chart and let's see exactly how it's firing off and when it's firing off, because that's important to understand when we can develop trade ideas from it and how we can kind of implement it into our own trading strategies. And I always say, guys, is that, listen, if you're using indicators, you should use them in addition to your price, not instead of. So you should be looking for a strategy that bolts onto your existing thing you're looking for. So the default settings for MACD are fast length 12, slow length 26, and signal smoothing 9. So that's basically telling us it's going to plot the difference between the 26 period moving average and the 12 period moving average. Now many charting packages are going to allow you to say what source do I want to take this from. Do I want to take it from the close of the day? Is the moving average going to be based on the close, the open, the high, low, the close? Listen, 99% of the time the close is absolutely fine. You're going to get very, very similar signals depending on how you're plotting it, but the close is generally what's used. I guess if you're trading something that was perhaps very thin, like a thin commodity or something unique, then you might want to take more of an average. So like the open, high, low, close divided by 4, or the high, low divided by 2, so you've got the midpoint of the range. Something like that might give you, instead of perhaps if you're getting a lot of skewed results based on the close. But honestly, for currencies, for indices, for the big stocks, close is absolutely fine. So let's plot it on. But first of all, I'm going to get rid of these things. I'm going to talk about literally the MACD. So we've got a 12 and a 26. And what I will do, so we can see exactly what's being shown to us in the MACD, is I will plot two moving averages. And again, we just want a standard moving average. Don't want exponential, we just want standard moving average. I'm going to click that twice because I need two of them. I'm going to go into my settings here and I'm going to quickly change this one to 12. I'm going to have that as blue. I'm going to up the thickness a little bit so I can see what's going on. and here I'm going to go on to 26 because that was our slow period. Again, we want to make sure we're on the sources on the close style. Let's flip that to red and let's make that a little bit thicker so we can see what's going on. Okay, now something else I need to add on to here for us to see what's happening is a zero line, because as you might imagine, as you probably worked out already guys, is that as you cross as the moving averages cross each other, that's when you get your signal. And I also need to tick these to give us a simple. Okay, so when the fast period moving average is crossing over to the upside, as in we've got a great example here. So the fast is our blue, as you remember, and our slow is our red. As we cross to the upside, the MACD is going to cross over the zero line. It makes sense, doesn't it? Because we've got a number, and as they're crossing, as the difference between the two makes zero, that's when the MACD crosses the zero line. And that's going to happen all throughout the whole of the process, whether we cross below or cross above. And you can see, let's go to perhaps a downtrend here as we just start to cross below. If I can find one, here we go, it's a nice clean one here. We cross below at this point. Let me get my pen out once more. We cross below at this point, and then obviously this is where our zero line is here. We've missed it here, but that's our zero line, and we're crossing below it here. Great, so that's exactly what it's showing us. We can see that, it makes sense, it's clear. It's a nice way of displaying kind of what the moving average is doing without getting caught too much in the noise. Now, you notice that I hid some of the other things that we couldn't display here. And one of them is a histogram, and one of them is a signal line. So let's put them both on at the moment. Now, a signal line is a smoothing of that difference, and 9 is the generally the default setting, but of course you can play around with it as much as you like. What I'm going to do now is I'm going to suppress price. Obviously, I would never recommend suppressing price in the real world. You really don't want to be just getting rid of price, but just to see what it's showing us on the moving averages as they cross over. So as they cross over, you can see we crossed over the zero line. The signal line is smoothing that out. It's smoothing that difference out. So you can play around with the settings on that. The same with all these kind of indicators, guys. You know, the more I didn't really want to do that. The more smoothing you apply, you know, the less noise you're going to get, but the kind of, you know, much shallower waves, the amplitude of the wave is going to be just lower. It's the same with your moving average. So you need to kind of adjust and say, do I want more signals, do I want less signals, do I want a few false signals? But my guess is, let's always just start off with the default settings, play around with them, and then adjust them to perhaps the volatility of the market, the conditions of the market, the kind of market that you're trading, your currencies, indices, what have you. Okay, so those are the basics of the MACD. That's how it's constructed, that's how it's calculated. Let's have a look now at some signals, some trading ideas. So hop over to the next video, guys. We'll talk about some trading ideas, some setups, some ideas, some strategies that we can use the MACD for to perhaps make us some better, more profitable trades. See you in the next video, guys. Take care. Bye-bye.